Good morning from our global headquarters in New York. I'm Menace Granny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
A global bond market rout. UK yields spike again, breaking through the highest level since 2008. The final push by President Biden, fresh export curbs on Nvidia and the chip industry days before his departure. And wildfires rage on in California. Schools and businesses close. More than 100,000 residents evacuate. Manus, good morning to you.
Good morning to you, Danny. We'll talk more about the LA fires in just a moment. To the bond market. The shocking rout of 4 days in the U.S. bond market has just paused. Now, whether that endures is a very, very big question. Don't forget, Stephen Major with us 24 hours ago saying in this zone 4.5 to 5% is where other people's fear you want to trade in. Now, the UK market continues higher. This rout endures in the UK, the highest since 2008. Likewise in Japan. Even though we had successful 30-year auctions in Japan, you are looking at a fourth day in a row of a sell-off in the UK, and Japan at a decade high. The question for these bond markets is really what stops the bleed in the UK is a fiscal and Bank of England response. And here in the US, well, perhaps it's a weak non-farm payrolls. Roll it over. The cash market is closed. We're showing you the futures. Obviously, today it is the funeral of President Jimmy Carter. But really, these stocks are sort of trying to holding out for the hero that is perhaps a Goldilocks non-farm payroll, Danny. That is one thing that's out there. But futures are lower this morning. Of course, we'll talk more about the chip story in just a moment.
And just a reminder, it is the National Day of Mourning for the late President Jimmy Carter. So that means for your trading purposes, U.S. stock markets will be closed. Futures will close early at 9:30 a.m. Eastern. Treasury markets, they are open, but they have an early close at 2 p.m.
Markets are still moving, and we will talk through the moves with Sumant Wahi of Man Group later in the hour. Marvin Loh of State Street joins us to talk all things in these bond markets. Danny.
I'm really interested to talk with Marvin Loh about this idea of what is moving yields across the world. And it's a really important thing to think about. If it's just inflation, Marvin argues, it's something that we can handle. If it is a term premium increasing, if it is demanding more yield, like he says it is in the UK, then it's worrisome and has real ramifications for fiscal headroom in countries like the United Kingdom.
And this is very different to what we saw in 2022, which was a mini budget where bond yields in the United Kingdom blasted higher by 100 basis points in the space of 2 days. This time, it is about fiscal concerns in the United Kingdom, but it is also very much a global bond repricing. And the question is whether the gilt market is the tail that's wagging part of the U.S. dog or the other way around. But either way, these bond markets in the U.S., they are suitably unnerved.
Well, it's hard not to argue that it started here in the U.S.
100%.
It's not continuing here in the U.S., and that's the worrisome thing. The U.S. can maybe handle that. They can maybe handle the higher deficits. At least we've seen with auctions, for example, that we're willing to absorb the market. UK needs foreign investors. How willing are people right now to jump into this market? While Rachel Reeves, the chancellor there, deals with a fiscal budget already blowing out because of what's happening with yields.
And this yield spike has, in theory, cost her the headroom of around £11 billion. That's according to Bloomberg. Let's get to London, to our UK reporter, Valerie Teitel. Valerie, can you put some context around this, the moves in sterling and the gilts? Good morning.
Well, look, Manus, I'll start with the good news, is that at the open, the picture in the gilt market looked a lot worse. Those 30-year gilts opened nearly 11 basis points higher. We are now off those levels. That is the good news. The bad news is that these yields are still higher, and with it, that government's UK fiscal headroom is almost certainly eroded. The picture is also looking negative when it comes to the FX space. Another hit to the pound, and we've seen a flurry of downside options bought by traders who think out there that this move might have legs, and perhaps this is just the beginning for the UK. Put these two things together, and we are having flashbacks to the Truss era move where we saw that massive spike in gilt yields. Now, remember, back in 2022, we had an over 100 basis point move in the 30-year yield in just a few days. So we have not yet got to those levels, but we are sure drawing those conclusions as the market does question the UK's fiscal discipline.
Yep, it's certainly a moment of truth for the UK. Valerie, thanks so much. Bloomberg's Valerie Teitel. U.S. Treasuries, on the other hand, it is something different there. The sell-off is taking a breather ahead of an early close. Yields are lower by 1 basis point for the 10-year yield. Joining us now is Ven Ram of Bloomberg's MLive team. Ven, at the moment, even if the quake started in the U.S., it is more calm at the moment. Can the U.S. stay immune to some of the quakes now happening elsewhere in the world?
I think that the US is going to kind of operate on its own dynamics, but it's a slow burn from here, Danny, because if you look at the 10-year yield in the US, we have done about 100 basis points since the middle of September when the market started thinking maybe this is the Trump trade. We need to bring in the Trump trade. So we have done 100 basis points. We'll probably have another 20, 25 basis points to go based on what the implied volatility in rates markets are signaling. So I think that we've got 20, 25 basis points to go over the next 10, 15 days. That's still a lot of velocity if you look at the space within which those moves have happened. Now, the potential inflection point will come around Inauguration Day. Should there be an announcement about universal tariffs, that has the potential to roil the treasuries even higher, treasury yields even higher. But if there is no major announcement, or at least an announcement that is much less subdued than what the markets fear, then I think that treasury yields will come off those levels. So I think that, net, where does that leave us? That leaves us with an upside on the treasury yield of around 495, 497 on the 10-year yield, and perhaps a lot of downside after that, depending on the announcement.
Ven, good morning to you. It's interesting you talk obviously about January the 20th. The Fed in the minutes yesterday saying they'd placed, a number of them had placed placeholder assumptions in terms of what may come. I thought it was interesting, Chris Waller talking about lower inflation. If, as I expect, tariffs do not have a significant and persistent effect on inflation, they are unlikely to affect my view of appropriate monetary policy. And this is the crux of it. It's whether it's tactical tariffs or something more enduring and inflationary.
Well, I think that, there's the question of tariffs, and opinion is split. As you mentioned, Christopher Waller takes that opinion. But, opinion is not, the jury is out on what that will mean for inflation. And let's not also forget, it's not just about tariffs, it's also about the potential for tax cuts. It's not clear if there will be tax cuts and whether the House will, whether Congress will pass any such legislation. So there is a lot of uncertainty here, and it's that uncertainty premium that treasuries are reflecting at the moment. So, on the dot plot itself, you mentioned Christopher Waller, but if you look at the dot plot showed a number of participants penciling in a higher Fed funds rate, materially a higher Fed funds rate for the end of 2025 than they had penciled in back in September. So that speaks to the concerns across the Fed and not just one person.
Well, it's the opposite of the Greenspan conundrum. This time around, they're cutting, yet yields are moving higher. And it's not good for anyone, Ven. Obviously not good for Treasury investors, not good for equity investors as they worry with the threshold that things are up for them, not good for people looking at potentially higher mortgages, and the government that needs to worry about their spending. So to what degree do we need to see a Fed that starts to react not to just some hypothetical of what happens to tariffs and inflation down the line, but the here and the now of what's happening with yields moving against them and a market that's run away from them?
Absolutely, and you make a great point, Danny. Look, the Fed is going to be data dependent for the short term, because no one knows exactly how any of these announcements are going to ripple through to the markets. So I think that they're going to be far more data dependent. And what is a valuable cue for them is the idea of the neutral rate. The Fed has penciled in an implicit neutral rate real neutral rate, mind you, of 1%. So if you take core PCE, that's hovering around 280, closer to 3 at any rate rather than 2, then you're talking about a real restrictive rate of 4% plus. And so the headroom for the Fed to cut rates from here is not very much. So which is why they're going to be walking very carefully here, and they are acutely mindful that the real neutral rate has probably shifted higher in this cycle.
Well, certainly the cost of servicing this debt is something that even President-elect noted in his press conference the other day. Ven, thank you very much. Ven Ram putting context around these bond market moves from the MLive team. There are other stories trending on your Bloomberg terminal. Let's get you up to speed. The Biden administration planning new restrictions on NVIDIA AI chip exports just days before leaving office. It's the final push to keep advanced technologies out of the hands of China and Russia. The regulations would create 3 tiers of chip curbs. That's according to people familiar with the matter.
A U.S. dock workers union has reached a tentative agreement on a new labor contract that, if ratified, would avoid a shutdown of the East and Gulf Coast ports next week. The new agreement would guarantee union jobs when certain technologies are implemented. Those include the automated cranes that had been a public focal point of the debates.
Los Angeles is fighting its worst natural disaster in decades. Wildfires driven by hurricane-strength wind gusts tore through prosperous neighborhoods, killing at least 5 people and forcing 100,000 residents to evacuate. President Biden has cancelled his trip to Italy to help monitor the response to the fires. Coming up, we speak to Sumant Wahi of Man Group on the real impact that AI is having on the economy. That's in just a moment on Bloomberg. Bloomberg Brief. I'm Menace Rennie alongside Danny Berger here in New York, giving you everything that you need to know through the day. Global banks will cut as many as 200,000 jobs in the next 3 to 5 years. This as AI replaces human roles, according to the survey by Bloomberg Intelligence. Sumant Wahi, portfolio manager and tech equities at Man Group, writes this: 2025 will be about the real expressions of Gen AI that have meaningful adoption and a real impact on the economy. I'm pleased to say Sumant joins us now. Sumant, if we ever wanted a story that was a gift on a day when we were going to have you on, this is it. This is the personification of AI in banking. My question to you is this: as you stand back and look at the world, is this the tip of the iceberg in terms of adoption? Do we have a Moore's Law proposition for AI adoption? That's what we need to understand, isn't it?
Indeed. Good morning. Thank you for having me. Absolutely. If you think that the last 2 years were all about investing in AI factories, and we've seen the phenomenal run because of that in the tech sector, I think 2025 is definitely a year where we should see a real impact of the expression of AI, which would have a meaningful adoption as well as a real economic impact, if you will. So banks, of course, are looking at this as a space to improve their productivity, and we should see that go across the rest of the sectors as well.
Well, Sumant, I think what caught a lot of people's attention was last summer. You had Walmart earnings, and Walmart comes out and says, we did the work that would have required 100 times as many people to go through our catalog by using AI. That's some real efficiency. As companies start to adopt this, who is the beneficiary? Because at the moment, it's been concentrated on NVIDIA and maybe even an energy play as people build up the data centers. But as it gets implemented, who are the winners of the group?
Absolutely. I think to a certain extent, the AI factories will continue to grow, albeit at a slower rate. But alongside that, I do believe that there is a lot of investment which will go into software. Now, we've had some examples last year of AI expressions, whether that was in AI smartphones or, for that matter, in AI co-pilots. But there was a mixed results to that. What I think we are more interested in is trying to find areas where the AI impact is material, but actually the change in business processes or human behavior is less so to an extent. So from that perspective, I think if you think about software in back office applications or advertising tools, not just for the industry majors, but for the wider, smaller players as well, those are areas where we should see direct impact immediately, if you will.
Well, talk us through what's going to happen with the consumer, because you've got the wholesale, as it were, at the industrial and banks, back offices, middle offices. That's the story of today. I've got ChatGPT on my iPhone. The question is how much more aggressively I adopt AI on a personal level, and when am I ready to pay for it? That is the magic sauce in this. How quickly does that come? And are those companies that you're just trying to mine and inform yourself of where you want to place the next major bet?
Absolutely. So I think if you actually think about that, last year when we did have some AI expressions, what was interesting is that wherever you required a change in human behavior or business process change, that was slow to change. And I think we should look at companies, especially in the software space, as well as in sort of chips beyond the data center vendors, who actually would allow for these AI expressions without a significant change in human behavior. I think that's how you actually benefit from it, and those are the chips, those are the players you should be investing in accordingly.
Sumant, already in 2025 and to end last year, the other big change that we saw among these tech firms was trying to right-size themselves to be prepared for a Trump administration. Meta has been maybe the poster child of this, putting executives up who have close ties to Republicans, changing their fact-checking to be one of community notes, more like X, everyone hoping to be like Elon Musk, the first buddy of the United States. When analyzing individual tech companies, how important is it to you that they have some strategy to deal with a Republican administration, that they move themselves in a way to kind of avoid maybe the ire or the spotlight of Donald Trump?
I think what the last 10 years have taught the tech companies is that you can't just be focused on technology. You need to be aware of what's happening with pop culture and what's happening in terms of a political landscape. Social media companies are no different from that perspective. But I do believe that some of these changes are also another form of expression of AI, because where you can actually use AI for fact-checking rather than humans, I think that can also be a strong way of demonstrating that. But to that point, that does help with the margins as well.
Who's better insulated? And I'm sort of almost asking and answering my own question. I look at the U.S. activity at board level in terms of connectivity to this administration, the incoming administration. The U.S. tech is just bigger and more insulated relative to the European peers, isn't it?
It is, and it isn't as well. I mean, you mentioned tariff earlier in your program, and I think one of the things which I find interesting from that perspective is that a lot of attention has been made on the US-China tariffs and the implications of that, but not enough discussion is done on what European bloc or what EU does in this scenario. As the European experts see increasing unilateral tariffs, it is a reasonable scenario to assume that the EU bloc takes a more neutral stance towards China. If you look back in history in the 1960s, when US and Japan were at the peak of their competition, the Japanese conglomerates invested heavily into Europe. It is not far to imagine that Chinese companies could do the same. Already, Chinese companies have manufacturing in EVs and batteries technologies in Europe, and they are major partners to the European players. So I think if we consider this scenario, and we definitely are in our investment, we do believe that there could be significant implications and winners and losers within Europe at the back of these policy changes.
Hey, Sumant, just really quickly here, because in addition to that, it's not just the tariff difference and the opening up to China that Europe makes a difference. It's also increased regulation. And again, using Meta as an example of this, they removed their third-party fact checkers for the US, but not for Europe because of European regulation. If you have increasingly divergent US and European rules for tech companies, what does that mean for the sector?
These are global companies with a global audience. They need to be focused on the local regulatory requirements. So I think from that perspective, I mean, European regulations and policymakers have been relatively focused on privacy and misinformation, and that's something which where the social media companies have to work accordingly. I think that's just the nature of the law of the land.
Sumant, really great to catch up with you this morning. Thanks for joining us. Sumant Wahi of Man Group. Coming up, a rare gathering of commanders-in-chief to remember and commemorate the life of the late President Jimmy Carter. You're looking at live pictures of Jimmy Carter laying in state. The public visitation hour ends at 7 a.m., so you can see people there early, getting there to see the remains of the former president. We will leave you with these pictures. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger, Manus Cranny, let's set your agenda.
A global bond run. UK yields spike again, breaking through the highest level since 2008. The final push by President Biden. Fresh export curbs on Nvidia and the chip industry days before his departure. And wildfires rage in California. Schools and businesses close. More than 100,000 residents are called to evacuate.
Our heart goes out to all the families there in California. Now, meanwhile, it is a bond market that we must ask the question, where do we crack 5% first? It is a reprieve, a rare reprieve, since yields have been moving higher for 4 straight days. For the 2-year, 10-year across the curve, lower by more than 1 basis point. It is, however, notably not a reprieve for For the UK market, for the European market, yields there calmer than they were this morning, but we are still at 4.8%, the highest 10-year yield since 2008. Meanwhile, equities, those will not be trading, at least the cash market will not be trading today, as the funeral of the former late president, Jimmy Carter, takes place. Equities, though, your future session, again, not looking horrible considering what bond markets have been doing. We are slightly weaker, being led by tech, down 0.2%. I should say the bond market will also close early at 2 p.m. It is an equity market and a U.S. Treasury market, though, Manus, that at the moment seems like it is immune from the worst of what's happening around the rest of the world, which there is some irony there, because you could argue that the sell-off internationally happened because of the push higher in the U.S., because of this realization that inflation is more sticky, but the ramifications are maybe more painful for places like the UK.
Well, the debate becomes, as Stephen Major 24 hours ago on this show said, stop obsessing about inflation. This is about a move in the real yield and about a dissipation in terms of what the Fed is doing. Where other people's fear 4.6, 4.7, 4.8 and 5%, that's where he says you step in and you buy. Although he can't find any bond bulls anywhere around him. And he said that lopsided market is critically important to understand as well.
If you want to look for a bond bull, you have to talk to Stephen Major. That's literally it. That's why he can't find anyone else, because he is the only
the last man standing at the moment.
Well, let me show you what the 10-year yield has looked like in the UK, because it's just been moving up every single day this week so far, now higher by 24 basis points. State Street's Marvin Loh is excellent on this, writing, quote, higher yields are leaving a trail of casualties globally, although we find the differences between what is driving higher yields important for investors to analyze. While far from the meltdown of late 2022, it does show a degree of fragility that is idiosyncratic to the UK. Marvin, I'm pleased to say, joins us now, senior global macro strategist at State Street. Marvin, what do you make of the reasons behind the move higher in yields and why it looks more dangerous and idiosyncratic in the UK?
Yeah, I mean, you know what, this is to a certain degree very different than what we experienced in 2022. So I want to start by that. There were structural issues in the gilts market that really fueled the volatility that we saw a few years ago. This time around, it's just bond folks doing what bond folks are supposed to do, and that's really looking at whether or not the obligor, in this instance the UK government, has the ability to pay debt, and we're getting compensated for that risk. Straight out, there's a lot of fiscal issues. Those fiscal issues have really developed over the last 5 to 10 years in terms of some of the Brexit votes and the more isolated aspect of the UK economy, but one where higher yields globally really is asking investors the questions of whether or not that sustainability is something that not only the UK, but other governments and really, everyone who borrows debt is able to service.
Marvin, good morning to you. Let's just extrapolate a little bit further. The UK had a mini budget in 2022 that was a long-end insurance company and gilt market dislocation. Yes. This is structurally different. Sterling is down, but on a broad basis, it's nowhere near the nadir that we saw in 2022. So what stops this spiral in gilts and sterling? What stops this vortex turning on itself?
Yeah, you know what? This is really the markets forcing the behavior that they want to see, and it's something that we should be asking ourselves across all of the fixed income markets that we invest in. And really, it's a question that we should always be asking within the fixed income markets. It's now up to the government to address the problems that the market is bringing to the forefront. The mini budget that was put out has very, very little headroom. It includes both spending as well as tax implications of it. And that balance is so fragile that the increase in yields that we saw globally really erodes that small window. They need a bigger window. They need to address it. And, really until they do, it's open season for bond investors to continue to show that degree of concern. And the way we do it is vote by voting to leave that market.
The UK Budget Office, though, the UK Treasury there, has been very clear, Marvin. They released a statement saying that we are going to abide by our fiscal rules. The U.S., on the other hand, you have Republicans in Congress still talking about extending tax cuts. You have Trump talking about one big, beautiful bill. He still wants to do things like remove the tax on tips and talking about tariffs be the thing that saves us or more growth be the thing that saves us. That doesn't seem, to your point, Marvin, like an American government that wants to rein in spending at this moment.
Yeah, the weaponization of the deficit has really, in the U.S. in particular, has been a concern of mine for quite some time. Not to not to jump on the soapbox again, but you're kind of setting that soapbox up for myself. The debt sustainability issue is something that we've been concerned about for quite some time, and ultimately we're not necessarily that surprised that we see U.S. yields where they are. So the market is already starting to facilitate those concerns. For sure, this increase in real yield, while inflation expectations remain fairly well contained. Certainly they're going up, but not to the degree that one would expect given how volatile yields have been, is a pushback against everything that we're seeing in Washington. The U.S. has a lot more levers. The reserve currency, the dollar, the fact that treasuries are held so widely around the world does give us many more avenues to explore, if you will. But ultimately, I do think that the market is going to get to a point where, we have so much debt, and you've got to at least give us an idea that you're taking this fiscal situation more seriously.
Well, here's the issue. You said it's an open window for bond traders, bond bears, not necessarily the vigilantes yet. What is the kind of capitulation level for you, Marvin, in terms of the extension of the LCJA, the tax cuts from 2017, plus, as Danny just said? Is there some kind of number from a fiscal point of view that really pushes this bond market up and over the 5% hill?
Yeah, I mean, if we take a lot of the fiscal proposals that are on the table, you potentially could have a debt to GDP ramp that gets you towards 10%. No, I'm sorry. You get a fiscal deficit that gets to 10% of GDP. I think if we start talking about those types of numbers, investors are really going to question whether or not they're willing to buy the longer end of the U.S. curve. And kind of this curve steepening, which really has characterized the challenges in the U.S. debt market, is one where we start looking at, 2s, 10s that are somewhere in the 50 basis point range now, go into the 100+ basis point range. That becomes unsustainable, and it really does have knock-on effects, not only beyond the Treasury market and the U.S. markets, but really globally, because it will pull yields higher around the world.
If we have a moment like that, Marvin, you were just discussing that the state of the UK market structurally is in a better shape, with no fear from the pensions blowing up like they did in 2022. But elsewhere, are you confident that institutions have right-sized their interest rate exposure, that places like regional banks, that if we do get a ramp up again in long-end rates and rates in general in the entirety of the curve, that we aren't susceptible to those moments of fragility?
No, the fragility definitely is something that one needs to watch. So far, and we do look at this on a daily basis. Funding and kind of the structure of the market still looks relatively solid, but for sure, the knock-on effects of these kind of black swan type events are one that you're always on the lookout for, and ultimately you don't know about it. But so far, it does look like there's some stability, and we've taken care of some of those concerns. But for sure, I think the smaller banks that have exposure to treasuries and maybe not have as much wherewithal to really do the hedging that the larger banks have taken upon over the last couple of years still remain a bigger concern kind of within that discussion.
Marvin, let's just wrap this up very briefly. 4.66 this morning in the US 10 years. Are you fearful at this juncture there's another leg lower, or would you see it as an opportunity to step into duration at this juncture?
Yeah, I'd probably, if I was a trader, I do like levels around here. We've seen auctions start to stabilize a little bit, but for longer-term investors, I think there's going to be better opportunities. I do think that 5% that you've been talking about, Manny, and that all of us have discussed over the course of the last 6 months is something that's going to come to fruition this year.
Okay, Marvin, thank you very much. Marvin Loh there of State Street. There are other stories trending on your Bloomberg terminal this morning. Let's get you up to speed. U.S. Dock Workers Union reached a tentative deal with a new labour contract that, if ratified, would avoid a shutdown of the East and Gulf Coast ports next week. The new agreement would guarantee union jobs when certain technologies are implemented, and includes the semi-automated cranes that had been a public focal point.
Eric Schmidt, the former CEO of Google, has made a significant investment in 3D printed rocket maker Relativity Space That's according to people familiar. The company is developing the Terrain R rocket, which is set to launch in 2026. It received a $4.2 billion valuation in 2021. A representative for Schmidt declined to comment.
Los Angeles is fighting its worst natural disaster in decades. Wildfires driven by hurricane-strength wind gusts tore through prosperous neighborhoods, killed at least 5 people, and forced more than 100,000 residents to evacuate. President Biden has cancelled his trip to Italy to help monitor that response to the fires. It is Bloomberg Brief. I'm Manish Graney alongside Danny Berger in New York. 11 days until President Biden vacates the White House, and he's making one final push on AI with additional export restrictions. This is on chips from firms including NVIDIA and AMD. That is according to Bloomberg sources. NVIDIA is objecting, of course, to the proposals in a statement, writing this: a last-minute rule restricting exports to most of the world would be a major shift in policy that would reduce the risk of misuse and would threaten economic growth and U.S. leadership. Tom McKenzie's tracking the story for us. Tom, this last moment really to restrain the export of high-end chips by the Biden administration, is this about protecting and ensuring that third-party access for China and other adversaries, let's say like Russia, is contained? What's the essence of this last push?
Yeah, Manus, I think that is a key component of this latest set of restrictions, which, again, according to reporting, could come as soon as Friday. And it builds, of course, on the restrictions that started with the Biden administration back towards the end of 2022, and they've ramped up. So it's within that context. But the idea that China hasn't been able to get hold of AI accelerators is a nonsense. They have been able to, even if NVIDIA is not able to sell its Blackwell latest GPUs and AI chips into the Chinese market. Neither is AMD, by the way, on the most cutting edge. China, using sophisticated supply chains, has been able to get access to at least some. We know that through reporting. So I think there's a key part of it in trying to put in place further restrictions that make it more difficult for China to source from third-party countries. There's going to be 3 tiers. The first tier is US allies, like the UK, like Canada, like Japan and Taiwan. They'll have essentially unfettered access to these AI chips. The third tier are adversaries, China and Russia. Not a big surprise. It's the second tier, to your point, which is interesting, which is essentially the rest of the world. They will have, at a sovereign level, caps and limits on the number of chips they can get hold of. Companies operating in those countries can try to get more chips, but they will have to be approved by the US, get certified by the US on issues like security and human rights. It gives the US that huge leverage at a time when US chip companies, of course, are leading the charge and are more advanced in terms of their products.
It's also a reminder that Joe Biden is still president and will be so for less than 2 weeks. But then Trump comes into the administration. And we saw at CES, Tom, an acknowledgement of this. Jensen Huang talking yesterday with Ed Ludlow, saying that he hasn't yet been to Mar-a-Lago and he would welcome that invitation. CES is now wrapping up. How much of the conversation was this idea that, yes, AI is flourishing in tech, but with that, they also need to understand the political landscape that they're in?
Absolutely. And as Jensen Huang tries to position and future-proof NVIDIA with all these additional segments that they want to be able to commercialize with a time frame that is yet uncertain, that also increases the risks for NVIDIA, arguably on the politics. It makes them more exposed, arguably, to the tariff risks as they push into other jurisdictions and other segments of the market, even if it could and may well future-proof the business if, as some analysts think, the spend on data centers starts to ease off potentially, if not this year, then in 2026. It was part of the conversation at CES, and you did see other companies, competitors to NVIDIA, like Intel, but also AMD and Qualcomm pushing out their own AI chips, but with a focus on the laptops and the desktops that you may be using. So AI within the laptop, these supercomputers, quote unquote, will be more of a trend and more accessible this year, next year as well. That was a key theme. The politics overshadowing to some extent, and then there's some of the gadgets as well that maybe Manus would have liked, including a TV screen, by the way, which bends and melds depending on the content. I can just imagine a scenario where Manus is gesticulating and the screen shifts to accommodate him.
It's a brave new world out there. Tom, thank you so much.
There's very few things that meld to the movement of my instruction, Tom. I wish I had that power. That's Danny on the
I was
show.
going to say, you're going to make Manus rich with power-bending TV screens at
Wearing
home.
the chain from yesterday. It gets better.
Oh, goodness, Tom. Thank you so much for that evocative imagery, Tom McKenzie there. Okay, let's shift our focus now to Washington. Now, the Republican Party has the rare chance to update the tax code without having to make any concessions to the Democrats this year. But disagreements within the party still pose a risk that they'll miss the end of the year deadline. Trump, meanwhile, had a closed-door meeting with Senate Republicans yesterday on a big, single, beautiful bill. For more, let's bring in Bloomberg's David Gura in Washington. David, great to see you this morning. Where do we stand on the GOP negotiations over the single, big, beautiful bill?
You mentioned that meeting yesterday, and a lot of those Republican senators were impressing upon the president-elect that the way that they think he should go forward with this is to bifurcate it, to do it in two parts. And that's because they have seen, as we all have over these last few weeks, how razor-thin that margin is in the House of Representatives. Now, Mike Johnson, the Speaker of the House, is confident he can get one big, beautiful bill passed through the legislative body that he controls. But if that doesn't happen, Republicans in the Senate worry what that might signal or portend for their legislative agenda going forward. Now, Donald Trump is many things. A legislative tactician is not at the top of the list. So the takeaway that we got from that meeting last night is that he really just wants to see this done, wants to get this policy through, energy policy, immigration policy, fiscal policy, taxes as well, all of that rolled into one thing. He doesn't care how that happens fundamentally, and that's kind of been the story over the course of the week, is that he's not really staking out a position here, and that's kind of complicating things for Republicans in both houses of Congress who are really looking for him to lead on this issue, and so far he's been reluctant to do that.
Look, David, we know that the president-elect likes victory early, and this is where Lindsey Graham and Ted Cruz really say, look, let's do a narrower bill, $100 billion for border security, deliver that political quick win. What is it that will galvanize the Republicans behind one big, beautiful bill and not have this two-horse race?
What's going to galvanize them is the potential for it to get through. I mean, as you say, this is a policy positions that they promised on the campaign trail. They see this as a moment of opportunity to reverse and move forward their agenda. And if they see a path forward for doing that, I think they're going to want to do that. Of course, they're also going to do, as they've all said, what the president-elect wants them to do. They're eager to kind of follow his lead here, as I say. So I think it is incumbent upon him, Manus, going forward here to be that galvanizing force, to lay out a plan for them to do that. But as Danny said at the top, time is nigh here. They're aware of how tight this window is, their ability to do this now, and I think that might be something that motivates them as well.
David, I'm also really enjoying this trend of outgoing Biden administration officials doing their exit interview with you. One of such was Gary Gensler, the SEC chair, yesterday. What was your takeaway from that conversation?
It was fascinating. He's been a regulator kind of at the top of the echelon here for a lot of his life. He headed the CFTC during the Obama administration and the SEC most recently. And it's been wonderful to sit down with these officials and talk to them about the news of the day, but also have them reflect on their tenure in those jobs. So we've talked a lot about what he was able to do, what the SEC was able to do under his almost four-year tenure at the agency, and he's very proud of changes they made to the plumbing of the markets, as he's fond of saying, reducing that settlement time, for instance, work that he's done on China as well. Of course, I asked him about crypto, and this is the one thing that he's often asked about and kind of jokingly tries to push aside. He points out that in this $120 trillion capital market that he oversees, crypto is just a sliver of that, but I asked him about it, and here's what he had to say about sort of where things stand and what he thinks the SEC needs to do going forward.
In this field, it's rife with bad actors. I've been around finance for over 4 decades, and everything in the markets trade on a mixture of fundamentals and sentiment at any given time. But I've never seen a field that's so much wrapped up in sentiment and not so much about fundamentals.
A couple of things about crypto that I want to mention from him. One is we talked about how he early on in his tenure kind of set out to do high-profile enforcement actions, hoping they would send a message and change behavior. We acknowledged kind of in that conversation the fact that, yes, the SEC has gone after some big fish in the world of crypto, hasn't fundamentally changed both behavior and enthusiasm for crypto. And then I asked him about this misapprehension I think a lot of people in that world have. You know, he was at MIT, he researched digital assets, was somebody who was seen as somebody who understood the field and might bring that to bear in this job. I said, what did people not get about that? Now he's seen as kind of a villain to those who are proponents of crypto. And he made what I thought was a fascinating point, perhaps an obvious one, that as an academician, you can do research and think about things in a vacuum. But once you're in that job running this very unique agency, which is both a regulatory agency and a law enforcement agency, it feels different in that chair.
It sure does. And he battled hard with some of the industry's titans, didn't he? Brian Armstrong. Just ask him what he thought about Elizabeth Warren and Gary Gensler and the crypto world. Great interview, David. Great series of interviews. Well done. Great catches there. David Gurr, at the very latest. And David, Bloomberg's Anne-Marie Hordern will be hosting a special coverage of President Carter's state funeral. That starts at 9 a.m. New York time.
Let's get you set up for your Thursday trading day. It is a national day of mourning for former President Jimmy Carter, with his state funeral taking place.
And the equity markets will, of course, be closed today, with the Treasury market closing early at 2 p.m.
Now, before we get that, we will have some Fed speak that comes from Harker, Barkin, Schmidt, and Bowman. That kicks off at 9:30 a.m. That is it for your brief surveillance. We'll take things from here.